One of the key concepts which we will look a little more deeper into is the borrowing capacity or the serviceability. Let's look at what it really means. Earlier in the course, I mentioned that we would discuss this borrowing capacity concept a little bit more in detail. So let's break it down so that you understand it even more. Now, as I said, borrowing capacity pretty much determines how much a bank is willing to lend you based on your financial situation. It is not just about whether you think that you can afford the repayments of the loan, but whether the bank calculates that you can manage them comfortably even under tougher financial conditions. Now, lending decisions are shaped by government regulations under the NCCP Act, and each bank sets its own policies around these guidelines. But you ask, how do the banks actually assess this thing called the borrowing capacity? Well, the key factors that impact your borrowing capacity are things like the banks put a buffer on the interest rate that they will offer to you. By that I mean that banks don't assess you at the current rate which will be offered to you. They add a buffer of say about 2.5 to 3% to ensure that you can still afford the repayments if, let's say, the rates increase. For example, if your loan rate is 3.5%, the bank may calculate your ability to repay the loan as if the rate was 6%. Also, the bank has this assumption for the expenses that you do. Now, because bank uses a certain benchmark figures for living expenses, which are sometimes higher than what you actually spend. The banks also look at all your existing debts. Any loans, personal finance, or car loans are all assessed and based on the maximum repayments, not just what you are currently paying, but everything that you currently owe. This is where the credit cards are not your friends, because even if you owe nothing on the credit card, banks will treat your total credit limit on the credit card as a liability. For example, a $10,000 credit card limit impacts your borrowing capacity even if the balance on it is absolutely $0. So understanding the income assessment and lender policies before applying for a loan can help you plan better and maximize your borrowing capacity.